everybody. Welcome to Care Connection, the free live webinar for family and professional caregivers of individuals living with Alzheimer's disease and related illnesses. My name's Christy. I'm from the Alzheimer's Foundation of America, and I'd love to thank everybody for joining us today. Just a couple reminders. All participants will be muted throughout the webinar and are in listen-only mode. If you have any questions, you can type them in on the right-hand side of the screen, and we will have a time at the end of the presentation to answer any questions that you have. We also have the PowerPoint in a handout on the right side as well, if any of you would like that. Today we have a very special guest speaker, Jesse Sloan, who's from the American Association for Long-Term Care Insurance, and he's going to be talking to us today about long-term care insurance. So we're really excited to have him as our guest. So Jesse, whenever you're ready, you can go ahead and take over the floor.
Great, thank you. Can you hear me okay?
Yep.
Good, so let's get started. So I'm going to take you off speaker because there's a little noise outside. So first of all, I really want to thank everybody for giving up their time today. Oop, that didn't go well. Let's try that again, and watching this presentation. I'm going to cover, I prepared this just for the Alzheimer's Association and caregivers. My hope is to share some really interesting and relevant information regarding long-term care insurance claims. So I think you'll find it pertinent and relevant. The organization, I've been with the organization, I actually founded it in the late 1990s, but I've been in long-term care insurance going back to the 1980s. This picture is quite an old one of me. The organization functions to do a couple of things, primarily to help educate consumers and then support insurance professionals. So I like to say we don't really have a horse in the race. I'm pretty passionate about this subject, but we don't get funding from the insurance companies, etc. So the information I share is my opinion, not necessarily anybody else's. Let me give, many of you are not as let's say, old as I am in this, so let me give you a little bit of background to sort of put the whole topic into context. So the earliest policies for long-term care insurance started to be sold in the late 1980s, and the policies primarily were nursing home only policies. Today they are quite different. Today they're literally called comprehensive policies because they will cover needed conditions for folks who need care in their own home or in assisted living communities, and obviously also in nursing homes, skilled nursing facilities. The sales grew in the 1990s and the 2000s to as many as you could see, 750,000 policies were being sold a year in those days. And today, there isn't any hard and fast number of people who have some form of long-term care insurance. I will tell you it's about 7 million. It could be a little bit more because today there are more people who are buying what I'll explain as a linked benefit product. But today, if you're reading online, there's two types of long-term, there's multiple types, but there's two primary types of long-term care insurance policies. They're traditional policies. Those are the ones that most of you have heard of and are familiar with. That's what most of those 7 million people have. They are what are literally called health-based policies. But sales of those have shrunk in recent years, and new policies sold in 2019 are rather low. It's about 58,000. The second category of policies are what I term linked benefit policies. Those tend to be life insurance policies or annuity policies where if the policy owner needs qualifying long-term care and services, they can tap into the benefits. So let's say you have a $500,000 worth of life insurance, or not even that much, $200,000 worth of life insurance benefit, and now you need long-term care. Instead of the life insurance benefit being paid to your beneficiaries, you can start to tap those benefits to pay for qualifying long-term care. So that's sort of the market today. There are obviously the issues that you hear about, whether you're a consumer, or someone with a policy or someone dealing with consumers who have policies, and that's rate increases. And the other issue is, are claims being paid? And I'm going to try and cover both of those so you're a little bit more educated about it. This slide shows you, while there's a lot of focus on long-term care insurance is only a small part of the picture. And it currently pays, this is 2017, so it's a little bit old, but it pays about 4 to 5% of claims. And that's important, but it's important to keep this in context that it still is a small part. That said, every year we do a study. I do a study of how many claimants are being paid by the insurers and how much does the insurance industry pay out. So as you can see, the dollar amount of claims that gets paid out has increased every year. In 2018, it was $10.3 billion. The insurers understand that and have priced the policies to expect that. The number of claimants increases because people who own the policies age. And so that number will keep going up. So you will see more individuals with those policies going on claim and more claim dollars being paid out each year. Some interesting data that I would think is relevant to you on claims. Roughly two-thirds of all the claimants who receive benefits from having a long-term care insurance policy, so two-thirds of the claims paid in 2018 go to women. About a third, a little bit, it's roughly go to men. As I don't think that comes as a surprise to you. Women live longer. If you live a long life, the chances of needing long-term care are increasingly high. And then if you have a long-term care insurance policy, you're going to be very glad because that will pay. And by the way, you can see you can refer to this later. Our website is aaltci.org. And every year we post different facts, what policies cost, who goes on claims, a lot more of it. And the shortcut to it is LTC Facts-2019. That's where I'm getting this from. The age, when people go on claim is just an interesting matter. I probably repeat some things that, along this presentation, but you have to buy long-term care insurance when you can health qualify for it. It's one of the biggest misconceptions out there. It's sort of, I'm calling in from near Simi Valley in California, where the wildfires, if you're watching on TV, are burning. You can't buy homeowners or fire insurance after your house is burnt down or as the flames are approaching. This is something you have to buy and pay for in advance. And long-term care insurance is no different. You must buy it when you're healthy and can health qualify. We'll talk a little bit about that later. And you pay a small amount every year until you go on claim. So while some people go on claim at earlier ages, and we look at that every year, the vast majority of claimants go on claim after age 80. And you can see, how that spread works. 80 to 90, although typically I try to ask some of the insurers their oldest claimant when the claim starts, and there are claims that start after people are in their hundreds. That is not uncommon today. And again, I'm sure it's something that you see. Where do long-term care insurance claims begin? And these are new claims that started in 2018. One of the big misconceptions about long-term care insurance is that it's nursing home insurance. And the misconception exists because initially, as I said, those policies started as nursing home only. But I will tell you that for decades, the insurance companies, insurance agents really focused on those catastrophic costs of staying in a nursing home. The insurers never really stopped the world from doing that, even though they knew that most people were not using these policies for care in nursing homes, not using these policies, because a nursing home stay typically, if you have money and assets, typically was at the later stages of your life, even if you have, cognitive issues. So the vast majority of claims paid are for people receiving care in their own home, followed then by assisted living and nursing home. Less than 1 out of 4 new claims start with somebody going into a nursing home. And I tend, when I'm talking to consumers or reporters, when I talk about long-term care insurance today, I talk about it being nursing home avoidance insurance, because it really gives you the funds to pay for care in your own home. That is truly the key benefit. Now, years ago, everybody said, well, okay, we had started studying where do claims begin, but people inevitably said, well, but, okay, so it's a transition, obviously. People start to get care in their own home, and then they obviously transition to care in a nursing home. And that's not true. While that is clearly the case, that some people will start to get care in their own home and then transition because they'll need more services that can really be provided. As you can see, the shift is not that great. Claims tend to end where they began. And so most of that, again, is care in the home. Why do claims end? I don't read numbers from the slides, because if you're watching this, you can see it. Most obviously end because of death. Some end because they have exhausted benefits. And let me, I don't think I have a slide here, but let me help give a definition, because long-term care insurance is very confusing. Just the way the government and the regulators require that the policies were created. So you read a lot, $150 a daily benefit and period of years and all of that. All of that tends to mislead people. Really, what you have, picture a swimming pool. When you buy your long-term care insurance policy, the decisions that you make determine how much water, or in this case dollars, are put into your swimming pool. So one of the factors for figuring that is a daily benefit, what your initial daily benefit is. $150 a day, $200 a day, whatever somebody picks. Then it's the period of time. So could be 2 years, 3 years, 5 years. It used to be that there were unlimited or lifetime policies. They're very hard to come by today. And the truth is that most people really don't need that length of coverage. So you're initially using those factors to fill your swimming pool. Maybe your swimming pool has $150,000 initially in it of benefits. Then you add an option, which is your inflation growth option. It used to be a standard at 5%, but long story short, and I won't bore you with the details, today it might be 2%, 3%, 1%, or none. And that determines that swimming pool keeps growing deeper every year. You have more dollars in your pool. So for most people with a long-term care insurance, they do not exhaust their benefits. But I shared that with you because, yes, there are some who at the end have dried up all the money in their swimming pool. They have exhausted their benefits and now need to turn to a different Um, this is an older study. This comes from 2011. There is not, because the long-term care insurance marketplace is rather small, there isn't a whole lot of data on where claims begin, or that's updated periodically. But this is clearly relevant, and there probably isn't much of a change. And you can see that the number one cause for claim is Alzheimer's. That I don't think would be a surprise to any of you, but now you actually get to see it in print. And now let's talk a little bit about the market today, and then some of the issues. So I had shared with you that the market for traditional long-term care insurance products has been shrinking. The market for linked benefit coverage has been increasing. I won't tell you one is better than the other. I will tell you traditional coverage gets you more leverage for your dollars. But people like the linked benefit coverage because they like the fact that, if you buy a life insurance policy and you don't use your long-term care, well, then at least your beneficiaries get a death benefit. So they both can do exactly the same thing, but I would say more people are marketing the linked benefit coverage today in a better way. A couple of tips that I've taken this from a website, A Place for Mom, because I think it really is important. If you're caregivers, we get calls at the association from various types of consumer. Some consumers are shopping for a policy, and there the association doesn't sell, but we will match them with a specialist. We get calls from family members who really are not sure what to do once they have a long-term care insurance policy, and so we help guide them. And then we get calls from people who have policies and are facing rate increases or complaints, etc. And we try to give them a little bit of counsel as well. But if you have a policy holder that has a long-term care insurance policy, and let me start, if you have somebody who says, well, I think mom or dad does, and this is often the case, there is no repository of information where, hey, you can punch in their name and their social security number and see. At one time, there were about 120 different companies that offered long-term care insurance. A number of them obviously have merged. Most of them have outsourced their departments to off-site companies who handle claims, but there is no directory where you can go in and say, if I give you mom's social security number. What we tell consumers who are calling that is, one, a lot of people think they have long-term care insurance, but they really don't. They typically have Medicare, and they are mistaken in thinking that covers it. So the only way you can find it is to check their bank books, wherever they might be having automatic payments or be writing checks for a premium, and that will tell you who the company is. Once if they do have a policy, then there are things that you can help advise people to do in terms of moving the process along. And basically, it's designating a family coordinator. That's number one. Number two is reading the policies. These are contracts, and unfortunately, at time of claim, it's the contract and the print in the contract and the terms of the contract that matter, and not what the agent said verbally, not what the customer thought they heard verbally. It is a contract, and so it is really important that the family members or whoever read and understand the contract, and if they don't have it, call the insurance company and get one sent to them. The third is understanding the benefit triggers. Clearly, This is the key. This is what insurance companies will look for. While the ADLs are standard, the policy language can often be a little bit different. And that is important. It's not important for you to understand the differences, but it's important for the customer to understand that they clearly must know it. Obviously, the second way to trigger a policy, as you can see there, is a cognitive impairment. And again, it's really crucial to understand from the insurance company and talk to the physicians and get as much cleared up in writing and understood, up front, because that will avoid frustration in people looking and going, I have this policy. People think, let's say, if they're in an assisted living, that long-term care insurance should cover their rent. It doesn't cover rent. And so, understand the policy benefits. That's an obvious one. Follow up. What I tell consumers who do call, who do have concerns or complaints, because the insurance companies I showed you, they pay a lot of claims. They do not deny legitimate, authentic claims. What they deny is claims where the customer hasn't met the deductible, the elimination period, or where they haven't met the criteria that's outlined in the policy. So what I tell consumers that are dealing with either directly with the insurance company or more commonly today with an outside agency for the company is A, make the notes of the names of the people that you're speaking with, the time and the date that you called them. You can push it up the line and ask for supervisors, and again, get their names and numbers. And lastly, if you're having real trouble with it, there are entities that will come in and help. People go, I'm going to go to the state, Department of Insurance. You can do that. Unfortunately, that won't help elevate the claim. It's really, you just have to be an advocate. Characteristics of individual buyers. I don't know why I threw this in here. I guess to talk to you a little bit, to kind of change the subject directly and talk a little bit about more who should buy long-term care insurance, who does buy long-term care insurance, and at what ages do you need to do this. First, these are old statistics, 2010. As I say, we do some of it, but I guess I don't have it in charts. So you can see that the average age of buyers from the right going to the left has come down. Today, the average age is about 56, 57, and that is truly the right time to buy long-term care insurance is before you're on Medicare, and I'll tell you why. Once you hit Medicare, which I'm not going to get political and talk to people about what they think about nationalized or socialized medicine, but boy, did I love the day I qualified for Medicare, because now I go see doctors far more regularly, which is a good thing. The bad thing is when you do that, the doctors will put things in my record that could make me ineligible for long-term care insurance, no matter how much I was willing to pay. So I tell consumers, you should do this well before you apply for Medicare, because your health is really what buys you this policy. Typically, most people who buy long-term care insurance are married, although I would tell you as caregivers, if you are dealing with women who are on their own, single women who have never been married, divorced, etc., I think this is long-term care, and long-term care insurance is a women's issue. And I think it is sad that so few women who are on their own buy a policy. And often that's because I think insurance company or insurance agents often try to sell them a very expensive loaded policy, which would be great if they had the income. Often they don't. Some coverage for a single woman, I always believe, is better than no coverage at all, because if nothing else, it gives her some early on benefits and some transition. And she does not, I always like to say, I have a built-in caregiver. It's my wife. But a woman on her own, if at older ages she has, gets a hip replacement, or something like that, and now has to come home, she unfortunately has no built-in caregiver. That long-term care insurance policy, and one that would trigger home care immediately without any deductible, would be incredibly valuable to her. So, a little bit on long-term care insurance. As I'm talking to you, because again, while you're caregivers, you're also consumers who also go out and talk to other folks about it. Let me give you some real facts, because there's, again, so many misconceptions about long-term care insurance. And the cost of policies can vary significantly from one company to the next. But once a year, we do a study. So, here's a couple, both age 55. If their average annual premium would be about $3,000. If they wait until 60 to buy, waiting those 5 years would now increase their yearly premium to about $3,500. Now you look and you go, okay, after 60, 65, the cost starts to go up precipitously, but what's more important is that they may not be able to health qualify for these policies. And what's also important is, as you can kind of just see what I've shown here, this is for that initial pool of benefits. In this case, each spouse has about $164,000. But by adding in that 3% annual growth, what you're really seeing is they're paying $3,000 as a couple. So it costs them $1,500 each a year, $3,000 combined. But they each have, at age 85, when they're likely to need benefits for the age 55 couple, they're going to have about $386,000 in their swimming pool. The last number that I want to focus on this, because as I shared with you, you are advocates. You see this issue every day. You talk to people. It is, in my opinion, really important for consumers to shop around for coverage. Because when we do the price index, first of all, you only buy long-term care insurance once in your lifetime. Never pays to reshop it. It's not like your car insurance or something else where, Geico will save you, give us 15 minutes and we'll save you 15%. Once you have a long-term care insurance policy in place and you've owned it for a couple of years, it almost never pays to switch. Again, you still have to, assuming you could even health qualify. So when we do the price index, we look at the lowest price for basically equal coverage. The small print is going to differ, and that will be important. But for basically equal coverage, you could pay anywhere from twice to almost 3 times as much for virtually identical coverage. And the consumer doesn't know. They talk to somebody, who they think is an expert, and they're basically selling them. So it really pays to talk to a specialist. A couple of other points, that I share with you. And again, this is just to make you more educated, because you're people who talk to others and people who others respect. There are so many ways to design policies to make them affordable, especially, as I said, for couples and for women. So, most people pull column A, which what I call the off-the-shelf standard proposal. Every article you read in Kiplinger's, everywhere else, this is what they talk about today. $164,000, which is basically $150 a day, a facility benefit of 3 years with the 3% compound inflation growth option. And so the benefits at age 90 or 386, and it costs that couple $3,500 a year. I believe that option C is actually a better option. There are some companies today that offer some very innovative approaches. One of them is not one company, but one of the approaches is what's called shared benefits, where basically it's pooled benefits, so that husband and wife each have their own swimming pool. With option A, husband and wife each have their own swimming pool. If husband needs his care and depletes all the dollars in his swimming pool, well, he's done. That's it. With option C, there's two swimming pools, but you can share the water or the dollars from one pool into the other. In my opinion, what that allows you to do is put less dollars in each of the pool, thereby saving you some premium each year. So let's say you do that and you add the shared care benefit, and instead of a 3%, because you want those dollars to build, you now only add a 2% annual growth rate. Well, what it shows you at age 90 is each now has $310,000 in their pool. So yes, that's less than option A. But because typically not both people need long-term care in a relationship, sometimes it happens, but generally not often. And even then, there's ways to do it. You now have two pools with those dollars, but you get access to it. Now, you have to, it's a wonderful provision that very few people know about or take advantage of, in my opinion. And the policies have limits, and it varies from state to state, but it's definitely worth looking into. I shared with you, sort of towards the end of my information, I shared with you that, hey, you have to do this at early ages. This just shows you the percentage of people who have taken the time to actually complete an application, which is not a simple thing. This is not like, your name, your social security number, and your age. There are a lot of health questions that get asked and that you have to answer. But these people still feel that they're going to get approved. You can see that by the time you're in your 60s and 70s, and again, it's getting harder and harder to do it today than it was even when we did this study. The percentage of people who take the time to apply and are declined increases with age. And today, if you're declined by one company, you're almost assured to be not even accepted by any other company, because the cost of underwriting an applicant is anywhere from $600 to $800. So, $1,200 to $1,600 for a couple. The insurance company, if you've been declined by one, they look and go, why would we expend that money? So I always tell people your money pays for long-term care insurance, but your health actually buys it. Uninsurable conditions. This comes from one of the bigger insurance companies, and I throw this in here because of who I'm doing this presentation for. You can see there is a long list. There's my cursor of uninsurable conditions, Alzheimer's and dementia being one of them. Uninsurable medications. This is a long list of medications. Again, this is not for all companies, but clearly people, as I say, the number one call that we get from consumers is, hi, I'm calling, and the first question I'm calling to get a quote for long-term care insurance. And the first question we ask them, is this for you or for someone else? Why does that matter? Well, because if it's for someone else, we need to know how old they are. Do they need care currently, etc.? Are they on Social Security, disability? Do they take medications? That's even before we'll turn them over to a specialist. Lastly, I've been talking about this, and I truly believe that it is important. And as I say, I've done this since the late 1980s. I truly believe it pays for a consumer to work with somebody who specializes in long-term care planning options. That's because the products can vary, the pricing can vary, and whether they go with traditional or linked benefits, that can vary. The thing that I want to share is, how do you find or know who is a specialist? And this pertains to all types of insurance products, because every agent calls themselves, we all call them insurance agents. But there is a legal definition and difference between who is an agent and who is a broker. An agent, let's just say State Farm, we typically think of them. An agent is typically able to only sell one company. They are appointed by that company and typically can only sell products from their company, or maybe they have to first push those company products. So while they may be able to say, oh, I know all of the products, if they can only sell one, that's the one that they're going to sell or push, because that's the only one where they can earn a commission through the sale. A broker is appointed with multiple companies, and that's key, because then they're working in the consumer's best interest. They're going to look and say, I can sell you 6 different companies. I favor this one, but if you look and go, I don't like the name of that company, or I don't like that they're based in, this particular state, I can of course sell you a different one, and talk to you about it. But this is the one that I think is best for you. So I think that's important. Oh, and by the way, where do you find them? They can go directly to the association's website, aaltci.org. We have a little button there. They can fill in our quote form, or they can call us, and we will connect them with a specialist in their state. Rate increases. I'll only spend a minute as I'm getting ready to close and take any questions on rate increases. Almost every insurance policy that was written in the 1990s, the early 2000s, is going to be subject to a rate increase. Nobody likes to pay more. I'm the cheapest, most frugal guy that I know. I don't like to pay more for anything, and it's not that the insurance companies messed up. It's just that the world has changed. Investment returns are way down today. In those days, you could offer 5% growth on your policy because you could invest it at 7 or 8%. I all remember when we got CD. Listen, my kids think they can't believe it, but one day I told them, I said, I sent them a statement that I had found where I was getting 15.5% on a 1-year CD from Citibank. And they were like, whoa! And I said, yeah, and I didn't even have to go out and split wood for a fire in those days, and Lincoln wasn't president. Things change. Nobody likes rate increases, but they happen. We have some really good information on our website that explains to consumers. The shortcut might be rates. I also saw it as rate-increases, but it really explains to consumers what's going on and what would happen if they wanted to buy a new policy today. Because we literally posted a new story this morning. Anywhere from 70 to 90% of people who have these policies and are subject to a rate increase pay the new higher rate. Why? They realize the value of what they have, and secondly, they can't get coverage that's anywhere close to the cost of what they have even after the rate increase. So I wanted to cover that. And lastly, I said at the beginning, one of the things I was going to cover was, rate increases and paying claims. So a couple of years ago, you hear a lot, oh, this was, and yes, I understand that there are problems out there. We'll never say there aren't. I have personally helped consumers get their claims processed and paid. Sometimes the insurance companies, they're all staffed with real people. They weren't asked the right way. They didn't get the right information. The forms weren't correct. There's miscommunication, or sometimes somebody's lazy and just doesn't want to do it. So I've elevated claims up the line and put people together and had it work. But a couple of years ago, the U.S. Department of Health and Human Services did a major study on paying claims. And I pulled this one thing out there because what they found was, yes, claims were being, quote, denied, but they were being denied because people hadn't met the eligibility. or they had not, meaning typically these policies have a deductible period, so they immediately, hey, mom's in a nursing home, she should be paid. Well, it doesn't work that way if they have a deductible time period in there. That saved them money on the premium, but now you have to wait, or they didn't fill out the paperwork. But in general, this was their conclusion. The insurance companies tended to err slightly on the side of approving claims that may not meet policy contract benefit eligibility. This is the government doing a study and then saying, no, the insurance companies are actually paying more claims than even the government thought would have met eligibility. So I throw that out there again. I started saying I don't defend the industry, but I do believe in educating people correctly. So that kind of brings me to the end as we prepare for questions. There is a ton of information on the association's website, which is real simple to get to, aaltci.org. You can see that request no obligation quote button on the right if you ever have people who look and go, well, how do I even find long-term care insurance? Or they can call us. And I thank everybody for their time and for listening. And if there are any questions, I'm happy to take them.
Great. Thank you so much, Jesse. We do have a few questions. So the first one says, I have a policy that allows me to increase my benefits and premium every 3 years without the company reviewing my medical records. Would you suggest this over inflation protection? FYI, I got a policy at age 28.
Whoa. I have heard every now and then people who've gotten it young. So that's called a future purchase option. And basically, yes, that is typically common in policies offered by employers. And so my answer is depending on how old the person is now, but generally yes, because the employers threw that in there as a feature because, one, it kept the policy rate cheaper when you're at younger ages, but that pool of water benefits is low. And without that, it's going to basically be a very small de minimis benefit ultimately when you need care, typically at age 80. So my answer is yes, if you can afford it, yes, you're going to want or need more dollars in your pool. Also, make sure you understand, because some of the companies with those options, you don't have to take every one of them, but let's say you could skip one, skip two, but if you don't take the third offering, they might tell you you're no longer entitled to this again. So kind of understand how your future purchase option works.
Great, thank you. The next question says, how can you find a pooled or shared provider?
The best way is to, again, talk to a specialist, because you can tell them. Most of them, because, this is a long-term care insurance sale. Often these guys are on the phone with the consumer for an hour. And most of them will do shared screen presentations, just like we're doing now. The consumer gets sits in front of their computer, and now they can put things in. It typically takes an hour. This is a complex product, a complex topic. And that's part of the reason that a lot of agents, it's like, okay, now I've explained all of this and I've gotten you down the road to saying yes. Now I'm not gonna complicate it by talking about here's this other feature and let me explain how that works, etc. So again, you can call us. We'll find you a specialist who knows these products, knows, who offers shared care, how they work, how they might differ. There might be one or two carriers that offer it in your state. The differences, again, but the point is that's sort of why I bring it into the conversation. If you bring it up and say, I'm interested in this, show me how it works and price it for me, that's the best way to do it.
Great, thank you. And as a reminder for everyone, if you have any questions, you can type them in on the right-hand side on the control panel. The next question we have says, what may make you declined by a company?
It's typically going to be your health. So I went, on that screen, I guess you can pull off the PDF. That was from one major traditional carrier, but they're all pretty much the same. They will go through all of those health conditions. They'll also look at your medications. So if you're taking medications that are on that list, if it's, if there's a reason or an explanation, so common medications like blood pressure, cholesterol, those don't matter. But other medications do matter because the insurance company knows that those are a precursor for you eventually needing care. What I tell consumers who get very upset with it is it's great. We're all in good health, but we're all really in good controlled health. And the things that are keeping us in good controlled health in our 60s and our 70s are likely the things that are going to cause a need for care in our 80s, 90s, and beyond. And that's what the insurance company is looking for. The other thing they'll look at is height and weight. And unfortunately, in America, there are an awful lot of people that are who don't meet the height weight standards. That's the nicest way to say it. But again, if you have some health conditions, or if you're talking to people that have some health conditions, it's the specialist. Your typical agent will be like, well, let's just write out this policy and get it through and see if you're applied. I'm sure you'll be accepted, but you won't be often. And some minor conditions that are not accepted by one company may be accepted by a second. So people who take certain medications, for example, we're in California, and I got a call from an individual who was HIV positive. And now I've forgotten because I don't do the health underwriting. But, in many states, it was an automatic decline. But I called the specialist, and she looked and she goes, no, if this and this is the situation, might be acceptable from an insurance company in California. So if you have health conditions, it pays to shop your health with a specialist who knows what they're doing.
Great, thank you. And a follow-up to that is asking about if a family history of Alzheimer's disease could get you declined.
I'm not sure. There's a whole lot on that. I think some of I haven't asked of late, and I do not know, so I don't want to give the wrong answer. The insurance companies used to ask historical questions. Today, they're scrutinizing a little bit more. I again don't know. You could. You could call in to us, or email me. I haven't given my email here, but it's real simple. It's just my first initial J and my last name Slome, so SLOME at AALTCI.org. If the person asking that emails me, jslome at AALTCI.org, I'll ask a specialist, and then I'll learn, It really is, and that's why I tell people it's an enormously complex topic. I've been doing this a long time. I have such high respect for the folks who are specialists who sit on the phone and they don't even charge. They make their money if somebody buys insurance, but typically only 1 out of 7 people that they talk to buy. So that means 6 are getting free consulting. It's interesting business.
Great, thank you. The next question is, do claims agents get an incentive to deny claims?
No, absolutely not. It's, as I said, they really don't. They don't deny. I'm stammering because, yes, over the many years that I've been doing this, I have heard all kinds of tales and stories and intervened a number of times. I often, people will call the consumer reporter at their newspaper who will call us. and I will elevate it up the line to somebody. No, they don't get incentive to deny claims, but they're human beings, and it's a there isn't sort of a standard. It's not like Medicare, where there's certain rules and regulations, and if you put this medical diagnosis down, Medicare is going to pay. If you put that one down, it won't, etc. It is such a small still industry that it's not clearly defined. So they don't deny claims. That's not to say that there aren't good companies, bad companies, etc. But in general, I find it's more, the person is due. For some reason, the person that they're working with or that has worked with it looks and goes, no, I don't understand. And I can't cite examples, but I can tell you that over the years, we have helped people, so it's not like the insurance company said, nope, that person wasn't eligible. They said, yep, we'll review it. And once you buck it up the line, the senior person said, yes, they are eligible. We're paying this, of course. It's like anything else, I tell, I bought 2 pieces of luggage, and I share this because we're all human. So I bought 2 pieces of luggage that each one was supposed to come with a free TSA, lock. Well, we got 1 lock, not the 2. So I email the company, don't hear back, email the company, don't hear back, email the store where we bought it. Oh, of course we believe in customer service. We're moving it up the line to the rep. The rep sends me 2 locks. The company, 2 weeks later, sends me 2 locks. So if I hadn't done anything to move it up the line, I now wouldn't have 5 locks. I only wanted the 2, but I'm just saying, it's in every business. You're dealing with people.
All right. So the next question says, if my husband and I don't qualify to purchase long-term care insurance based on the medication list, is there anything we can do to change that? Is the only choice to go off the medications in order to obtain long-term care insurance?
One, I wouldn't ever advise that. Depending on your state, there are some policies that are called short-term care insurance where they pay benefits for up to a year. Generally, they also require some health underwriting. You could email me, tell me your state, and I'll tell you if there's short-term care insurance policies in there and have somebody call you. Generally, and I'm not sure if you went off medication, how long, but that would, just don't do it. Unfortunately, we don't have universal coverage in this country. We have the first state, Washington, that kind of has put in a home care benefit, but it's really de minimis that taxpayers will pay for. No, unfortunately, if you can't health qualify at this point, I would look and say you're going to have to find other options.
Right. Thank you. The next question says, do we pay the long-term care coverage even after we start using the long-term care?
On traditional policies, once you, and again, you always read the language of the policy, but in general, once you trigger benefits, you stop paying your premium. This is not like, which is interesting, health insurance or other types of insurance, even when, you continuously pay. Here, these policies are priced that once you trigger benefits, you stop paying premiums. If you go off, and I didn't cover that in that slide, but you see some people died, some people exhausted their policies, and some people recover. One of the benefits that some of the policies have is you may, not with cognitive or Alzheimer's typically, because you don't recover from that, but let's say you, had a condition, you broke your hip, you had something like that, and you needed care for 9 months, a year, because it was a particularly bad situation. But then you recovered. you would go on claim, and then you would start to, once you recovered, go off claim, you would start to pay your premiums again. Some of the companies restore your benefits back to the full amount. They refill your swimming pool.
Great, thank you. And a follow-up to that said, how come long-term care insurance is so low, only 4%?
There, the truth of the matter is, the buyers for long-term care insurance are very defined. One, you typically got to be in that age group, 55 to 70, Secondly, you have to be a planner. Not all Americans are planners. In fact, very few of us are. You read the statistics on how many have saved for retirement or have more than $500 for an emergency. You have to be able to health qualify. And we have an obesity epidemic. We have, lots of unhealthy, disabled people. Those all can't health qualify. So when you narrow down the pool to who actually can and will get long-term care insurance, it's rather small. As I always say, as I said at the beginning, long-term care is an issue that faces all Americans who live a long life or who have, issues, but long-term care insurance is only an option for a relatively small percentage of folks.
Great, thank you. Thank you, everyone, for all your great questions. We've got just 5 minutes left, so we'll try to get through the ones we have. So this next one says, my mom and dad had long-term care insurance for about 26 or 27 years. When my mom had beginning stages of Alzheimer's, she was paranoid about her money and canceled the policies.
Oh,
By the
God.
time I found By the time I found out and tried to get the policies reinstated, I was informed that I had missed by 1 day a reinstatement under an Alzheimer's clause. Is this common?
No. I don't know. Do people cancel their policies? How long? I don't know how long ago this was. Again, I would email me. I don't hold out a lot of hope because, but I'm willing to give it a try. If it truly was 1 day and all the records exist and the companies keep records of calls and all of that, I don't know that they'll make an exception, but it's, I've never gotten a gift. I always laugh when people do this. I helped somebody recently, and she was in Atlanta, and I helped her get something like $28,000 from the insurance company. And I said, "Oh, cool! Send me a pecan pie." Never got the pie. I'm willing to help even without a pecan pie, but I always look and say, someday, if that happens, whoever it is, they can send me a pecan pie.
Great, thank you. This next one says, can you talk about long-term care insurance and self-insured amounts?
So that's the tough one. The issue is, I tell people who have assets, okay, whether it's $500,000, $1 million, whatever. The issue is, will you spend that money on insurance, on care when you need it? And the answer is most people won't. Most people who have done the right thing and saved and been frugal all of their lives. That's why they have acquired those savings at retirement. And that frugality doesn't change when you get old and need care. It gets worse. So what happens is you turn your spouse or your kids into your caregivers. What I tell people is you don't need long-term care insurance to pay all of the costs. But if you have some, even if it's not enough to pay for everything, you're going to access care sooner. You're going to have more options. So let's use worst case scenario, nursing homes. Nursing home A is 7 miles away, and it costs $7,000 a month. Nursing home B is walking distance, but it costs $9,000 a month. Well, people who are self-insuring are often going to look and say, well, we're going to take the cheaper one because it's $2,000 less a month. But it's not that the quality of care, but the proximity. So the spouse or whatever can't just show up every day and make sure that the care is good. Getting 7 miles when you're 90 may be difficult or impossible. So long-term care insurance gives you more options. It helps you avoid turning your loved ones into your caregivers. It lets them supervise and oversee the caregivers. You just have more. So people who want to self-insure, I say that's great. If you look and if you both have made the commitment to each other, if you're a married couple, that you will spend the money on the other person's care. You will not, I end like this, you know, if I needed care, I would say to my wife, go out, get a caregiver. You shouldn't be doing all of this. Find out what it costs. And she would walk in and look and go, well, I found the caregiver. It's only $25 an hour. And my eyebrow will twitch. Why? Because my first job, I earned $1.50 an hour and $25 an hour. Holy cow. And she'll see my eyebrow twitch and say, never mind, we don't need it. If you have insurance, you're going to look and have the same conversation, but the husband in bed is going to look and say, call that such and such a company. Let's get some money from them because we paid all of these years. It's a very different conversation. So that's sort of how I advise people who are facing the self-insurance versus insurance, decision.
Great. Thank you so much. So we are all out of time. So for those of you who didn't get your question answered, you can feel free to follow up with Jesse afterwards. Jesse, I want to thank you for this presentation today. It was really great having you join us. And I want to thank everybody who participated on today's webinar. We'll be welcoming you back next month on November 14th at 1 o'clock Eastern Time. We're going to be having Michelle Olson from Creative Path Consulting, who's going to be talking about gratitude through creativity. So thank you all again for joining Care Connection today, and I hope you have a great rest of your day.